Hi, welcome back. In this session, we're going to start on our discussion of value investing. Now, if you ask most investors how they would classify themselves, many investors call themselves value investors. But as you will see in this and the next few sessions, it's easy to call yourself a value investor. It's actually much more difficult to behave like a true value investor. So let's set the ball rolling by first defining who a value investor is. The lazy definition is value investors invest in stocks that trade at low PE ratios or low multiples of book value. That's an incredibly lazy definition. There are lots of people who buy low PE stocks I would not think about as value investors. There's a slightly broader definition, which is that a value investor cares about value. But then don't growth investors care about value? Again, it seems to be very selective in its use of the word value. So I'm going to start this discussion by giving you my definition of what a value investor is as contrasted with a growth investor. Earlier in this class, I introduced this notion of a financial balance sheet. In a financial balance sheet, I look at a business and look at where it gets its value. And I argued that your value as a company, as a business, can come from investments you've already made in the past, assets in place, and investments I expect you to make in the future. How far in? As far as the eye can see, called growth assets. And there are only two ways I said you could fund this business. Either borrow the money, use your own money. To me, value investors are focused on getting their value back from assets in place. They invest in companies that get the bulk of their value from assets in place. Put simply, value investors look at growth assets skeptically. They say it's all in the future. It's based on speculation. Therefore, I'm not going to invest in it. Value investing focuses on assets in place. And the argument is they're better positioned, value investors are, better positioned in assessing the value of assets in place and buying companies that trade at less than the value of assets in place. This view of the world, good or bad, is going to have consequences. We'll talk about what kinds of companies will come through as cheap in a value investing focus of the world, but it's based on investments you've already made. Now, with that lead in, there are three ways in which value investing is practiced. One is what I call passive screening. What do you do in passive screening? You look for companies that have specific characteristics that make it more likely that they're undervalued. I'm going to show you the Ben Graham screens, which kind of got the ball rolling. And those screens came out decades ago. And in those screens, you're essentially looking for companies that you think are cheap. The second group of value investing is built around contrarian investing, where the argument is you're more likely to find something to be undervalued after a big shock to the system. What kind of shock? A bad earnings report causing the price to drop by 30, 40, or 50%. So contrarian investors look for companies which have been badly pummeled by markets, looking for bargains, companies where the prices are down but don't deserve to be as down as they are. And the third group of value investors I call activist value investors. What do activist value investors do? They spot companies that they think could be more valuable, but only if they change the way they run. And here's what activist value investors do to follow up. They take a position in the company, but they don't sit back and wait for the stock price to adjust. They put pressure on the company to change. Of course, that requires a whole set of characteristics that those activist investors have to bring to the table, and we'll talk about those. Passive screeners, contrarian value investors, activist value investors. Now, we'll talk more about screening in the next session, but I'm going to go back and show you Ben Graham's original screens. And this came from a very early edition of his book, Intelligent Investor, in the 1940s and 50s. Well, here's what he looked for in a cheap stock. He said the price-earnings ratio of the stock has to be less than the inverse of the yield on a AAA corporate bond. You're saying, what? Let's say the yield on a AAA corporate bond, AAA corporate bonds are among the safest corporate bonds, is 5%. The inverse of that yield is 20. You're looking for a stock with a PE ratio less than 20. So you're bringing in both interest rates and the level of the PE. Second, to make sure you're not capturing some aberration, the PE of the stock has to be less than that company's average PE over the last 5 years. So you're looking for a stock where the PE has dropped. Low PE where the PE has dropped. Third, The Ben Graham approach was heavily dependent on dividends. So the dividend yield, the cash you would collect each year, would have to be at greater than 2/3 of the AAA corporate bond yield. Remember the corporate bond yield of 5%? Your dividend yield would have to be 3.33% for the stock to pass muster. Low PE, down more than 60% over the average over the last 5 years. Dividend yield almost 2/3 or more of the corporate bond yield. Fourth, and remember, all these screens would have to be met. Your price would have to be less than 2/3 of book value. So the stock would have to be trading at well below book value. And to pile on, it has to be less than 2/3 of net current assets. Net current assets would be, net of whatever items you want to take out of it that you don't think you can collect. In addition, to prevent risky stocks from showing up, Ben Graham added a debt to equity ratio being less than 1 based on book value. Ben Graham's approach is very heavily dependent on accounting statements and accounting numbers. The current assets would have to be greater than twice of current liabilities. So you would not have a company where accounts payable could get you into trouble. The debt, so there's an added debt screen, would have to be less than twice net current assets. So 6, 7, and 8 ensure the company does not have either debt in the conventional form or accounts payable that could get the company into trouble. So you have a cheap stock that's down a lot, pays a big dividend, trades at less than book value, has very little debt. The last two screens bring in earnings screens. First is you want earnings that are growing more than 7% a year and no more than 2 years of negative earnings in the last 10 years. What chance do you think there is of any company passing these screens? Yesterday I took the entire global equity market, put all 10 screens, and not one company in the world passed all 10 screens. You think, why come up with these unrealistic screens? Maybe in 1945 or 50 or 55, where book value actually meant a very different thing than book value today, these screens worked. And that's something to remember. Screens are creatures of the time that they're created in. And at that time, maybe these screens yielded 20 or 25 companies. And Ben Graham's argument is these are truly undervalued companies which have growth and low risk going for them. And you should buy them. We'll come back and look at more screens. But there have been studies that have looked at Graham's screens. And, but before we look at those studies, it's well worth noting that Ben Graham's legend comes from, as much from what he wrote, Security Analysis and Intelligent Investor, as it does from his students at Columbia University, where he taught a class on investing and valuation. And among the students were Warren Buffett, perhaps his most famous student. I don't know whether Charlie Munger was a student, but Warren Buffett definitely was. And Warren Buffett and Charlie Munger shared a lot of the same respect for Ben Graham's work. But there were studies, especially one by Oppenheimer, that looked at the stocks that passed the Ben Graham screen and noted that they would earn a return well in excess of the market. Mark Hulbert, who used to evaluate investment newsletters, also seemed to suggest that newsletters that were built around Graham's screens, similar to Graham's screens, did better than other newsletters. That's pretty weak sauce. Neither of those studies, the Oppenheimer study is notorious holes in it. The one attempt to actually run a mutual fund using the Graham screens by James Ray really failed to deliver on the promised return. So it's a mixed message as to whether Graham screens could actually have made money, but it clearly opened the door to screening in general. Now, of course, as I said, Ben Graham's most famous student was Warren Buffett, and Warren Buffett's history as an investor goes back to the 1960s when he had a partnership. Eventually, though, the vehicle through which Warren Buffett is invested is Berkshire Hathaway, a company that has an insurance company in its middle. Geico uses insurance capital to invest in publicly traded companies and some private business. Essentially, it's a closed-end mutual fund embedded in an insurance company, run by the most famous fund manager of all time, Warren Buffett. Now, the legend of Warren Buffett is based, of course, on how well Berkshire Hathaway has done for its investors. If you'd invested $100 in Berkshire Hathaway in 1965, that would be worth $5.5 million at the end of 2024. You don't even have to do a comparison to the S&P 500, but if you wanted to, you could see how much better you'd have done as an investor if instead of taking the route of investing in the S&P 500, you'd put all your money in Berkshire Hathaway. This is one of those cases where you can't attribute to luck. The returns on Berkshire Hathaway have been so dramatically higher than the market that they clearly beat the structure of risk. This isn't just a lucky investor. This is a really good investor. Now, if you take a look at what Warren Buffett's tenets are, and there are dozens of books you can read on Warren Buffett and extract your own lessons. Here's what Warren Buffett seems to look for in companies. In terms of business, he wants a company that's simple and understandable. As I go through these characteristics, it's worth thinking about what kinds of companies you'd have missed as a consequence as well. Every great strategy also has blind spots. You have to think about those blind spots. Simple and understandable. A consistent operating history in terms of income and profitability. And favorable long-term prospects. So you want a good business that potentially has growth potential. In terms of management, Buffett was big on picking good managers. Managers who are honest and candid, leaders rather than followers. In terms of financial tenets, he wanted businesses that delivered a high return on equity, well above the cost of equity, and high and stable margins. In fact, Buffett concocted a version of earnings called owner earnings, where he added back depreciation, amortization, and subtracted capex. Kind of a midway point to free cash flow to equity that we talked about in the valuation session. And finally, in terms of market tenets, he basically wanted to use conservative estimates of earnings. In other words, he didn't put in growth estimates just because managers threw it out there. He used conservative estimates of earnings. And this is one area where you might get some pushback. He said, I don't believe in betas or risk adjusting. I want to just beat the riskless trade. In fact, I've often got pushback in my classes when I adjust discount rates for risk, saying, Warren Buffett doesn't adjust discount rates for risk. Why are you doing it? And my response is, go back and take a look at the certainty equivalent version of a discounted cash flow valuation. If you get a chance, go back to the valuation session. There, instead of adjusting the discount rate, you adjust the cash flows for risk. By using conservative estimates of earnings, you're effectively taking that approach and creating a pragmatic version of it. Buffett's basic view is Mr. Market is bipolar, is capricious and moody, and you're trying to take advantage of that moodiness. Selling to Mr. Market when he's over-optimistic and buying back when he's over-pessimistic. So the Buffett legend has a clear core, and for a long time that legend allowed Berkshire Hathaway to trade at a much higher price relative to its book value than other insurance companies. So in this graph, you can see the price to book ratio for Berkshire Hathaway, and you can see that over time the price to book ratio has drifted down towards what other insurance companies generate as price to book. In fact, between the last decade, the price to book ratio for Berkshire Hathaway is getting pretty close to the price to book ratio for insurance companies. Put simply, the Buffett premium seems to be fading. Why? One is age, right? When this graph started, Warren Buffett was and Charlie Munger, basically you have to think of them as a pair, were in their 60s. By the time this graph is done, Warren Buffett is 93 and Charlie Munger had passed on. So the Buffett premium is faded partly because people know, and Warren Buffett has been open about it, that Warren is no longer the person picking the stocks at Berkshire Hathaway. He has his hand-selected, managers doing it. They might be very good managers in terms of, Ted Wexler and Todd Combs, but they're not Warren Buffett. The Buffett premium is faded. That's part of it. But there are other forces that have also kind of reduced the Buffett premium over time. In fact, even if Buffett and Munger had not had the aging issue, these would have started working against them. One is, the more people know what you do and the more they imitate you, it might be a source of, it might soothe your ego, but at the same time, the more people imitate you, the less money you will make on whatever strategy you adopt. And that's definitely been true for Warren Buffett. The second is a scaling problem. When Warren Buffett started, he ran a tiny fund. By the time you get to the 1990s and this century, Berkshire Hathaway was one of the largest companies in the world. You were investing hundreds of billions of dollars. And it's tough to scale up. It's tough to earn the kinds of excess returns you do when you have hundreds of billions rather than $1 billion or 10 million to invest. And the third is the world has become much more macro driven, especially since 2008. What does that mean? More of day-to-day movements in stock prices are driven by macroeconomic and market variables than company-specific variables. Put simply, you can do everything right in picking a company, but the world can shift under you and you might not be able to make money. Now, in fact, building on that theme, as you embark on this mission to be like Buffett, who doesn't, right? I mean, look at that, the returns he was able to deliver. There are three things I would like you to keep in mind. First is you're operating in a very different market than the market that Warren Buffett entered in the 1960s. In fact, Warren Buffett has been open at the Berkshire Hathaway meetings in giving advice to young investors starting out today, saying they'd be better off today investing in an index fund than doing what he did. Why? Because there's so much more data, so many more people looking for bargains. The market's changed. The second is, especially in the last 20 or 30 years, some or a portion of Warren Buffett's success has come from the fact that he's become an insider. What does that mean? When Warren Buffett takes a position in a company, well, everybody knows he's taken a position. The managers of the company actually invite him in. So if you're the CEO of a company where Warren Buffett has taken a position in your company and you get a call from Warren Buffett, I will wager you're going to take the call. And when he suggests that you should try something different or do something differently, you're going to take his advice. So it's become more, there's an activist component, not in the sense of changing the management, but nudging management to doing the right thing. Something that you and I will not be able to do, even if we replicate the Buffett themes in terms of what we invest in. The third ingredient, and this I think is something worth thinking about, is patience. One reason Warren Buffett was so successful is he was willing to wait. Invest in a stock and wait. How long? As long as it took. Now you're saying, I'm patient too. Well, sometimes patience is not out in your control, right? You're an equity mutual fund manager. You're only as patient as your least patient client. So what allowed Warren Buffett to be as patient as he was? One is, the people who invested with Warren Buffett trusted him implicitly. They had such a high regard for him that when he came back and said, trust me, I know what I'm doing, but let's wait a few years, you waited. There's a selection bias. Most portfolio managers don't have that luxury. And second, and this is something that I think plays a role in Buffett's success, is Warren Buffett invested insurance company money. You're saying, so what? Insurance company money, you collect premiums from people, and your payouts are based on the actuarial tables. And the actuarial tables don't panic. In November 2008, at the peak of that financial crisis, I remember Buffett taking a position in Goldman Sachs. At that time, nobody wanted to buy an investment banking stock after seeing what happened at Lehman. Warren Buffett took a position. He got a great deal because Goldman Sachs wanted him as a shareholder. That goes with being an insider. But he was able to do it because he said, look, I can wait. The actuarial tables don't panic. I don't need the money right away. So if you decide to be like Buffett, it's not as easy as it looks in the book, just investing like he does. And I'm not sure replicating what Buffett did will deliver the kind of returns today that it did for Buffett in the 1960s, 70s, and 80s. Doesn't mean you shouldn't try. But as you read about the Sage of Omaha in the books, and people read the Berkshire Hathaway, I admire Buffett because he's got this core philosophy that he goes back to. I mean, his strategies have shifted over time, but he's clear about what he believes. But it's worth remembering that his philosophy was one built around mature companies. And later we'll talk about one of the limits of traditional value investing, at least as practiced the Buffett way, is you're going to not have too many growth companies. In fact, Buffett is open about the fact that one of his great regrets is not buying Microsoft, even though he was best friends with Bill Gates, or not holding tech companies when they were growing and young. So the Sage of Omaha, amazing investor. The people who tracked what Warren Buffett did, I'm not so sure that they were able to replicate his success. In fact, I would wager that if you take the crowds of value investors who show up in Omaha every year, and you look at their track records over the decades that they've been investing using the Buffett approach, outside of the Berkshire Hathaway investment, which is Buffett's, you're living in reflected glory, I'll wager that the rest of their investments have been pretty average. It's easy to behave like Buffett and replicate his actions. It's difficult to have his staying power and his patience. And it's even more difficult to deliver the kinds of returns that he did. So we'll talk more about value investing as we go along. But in this session, I just wanted to introduce you to those two leading lights, Ben Graham and Warren Buffett, who drive so much of traditional value investing thinking. I hope you found this session useful, and I thank you very much for listening.